So you've probably seen the headlines, right? Bitcoin just erased an entire year's worth of gains in just a matter of weeks. We saw traders lose their life savings practically overnight. And yeah, everyone is screaming about a crypto winter. But what if the real story here isn't just another classic boom and bust cycle? What if something fundamental has shifted? Okay, let's get into it. First, let's just try to wrap our heads around the sheer scale of this. In only 6 weeks, $1.2 trillion of investor wealth just vanished from the crypto market. That is a truly staggering amount of money, gone in what felt like the blink of an eye. But, while the entire financial world was reeling from that number, a totally different conversation was happening online. Over on places like Reddit, the reaction was, well, it was raw skepticism. And this one comment really captures that feeling so many people share. Was any of that money actually real to begin with? This kind of sets up the big conflict, right? Is this a story about a massive financial loss, or is it about something else entirely?
Okay, so what was the tipping point? What kicked this all off? Well, back in mid-November, Bitcoin, which is kind of the bellwether for the whole market, it broke below a really key psychological level of $90,000. And look, this wasn't just a dip. This was a nosedive. It wiped out all the gains for the entire year and sent these huge waves of panic through the whole digital asset world. Whenever a crash this big happens, the first thing everyone does is look for a reason why. And pretty quickly, analysts started pointing to what you might call the usual suspects. Basically, a perfect storm of really powerful forces hitting the market all at the same time. Let's break down what they were. It really boils down to 3 main things. First, you had big investors pulling their money out of crypto ETFs. And if you don't know, those are just investment funds that let you buy crypto like it's a regular stock. Second, there's a lot of uncertainty about whether the U.S. Federal Reserve was going to cut interest rates. And that makes risky things like crypto look a lot less attractive. And third, and this is the big one, a massive unwinding of leveraged bets. For anyone who's new to this, leverage trading is basically just using borrowed money to make gigantic bets. Now, it can amplify your gains, sure, but it also massively amplifies your losses. So when the price of Bitcoin started to fall, it kicked off this domino effect of automatic sell-offs as all these borrowed positions got liquidated. It turned a small dip into an absolute catastrophe, wiping out traders in a matter of minutes. And that brings us right back to the big players. In just 1 week, nearly $2 billion got pulled from those crypto ETFs. And to be clear, this wasn't your average person panic selling on their phone. No, this was a clear signal that the large institutions, the so-called smart money that had fueled the whole rally, were now leading the charge for the exits. So naturally, the big question on everyone's mind is, what's next? And this is where the experts are just completely split. Is this the start of another long, cold crypto winter? Or is this actually a necessary, maybe even a healthy reset for the entire market? On one side of the coin, you have the pessimists. They're worried because there's just less money flowing in to buy up crypto. And they see these huge investors making massive bets that the price is going to fall even more. But on the other side, you've got the optimists. They're arguing that the big institutional players are still in it for the long haul, and that if you look at history, these kinds of crashes tend to clear out all the gamblers right before the market makes a major comeback. Now, that whole debate is fascinating, but what if both sides are kind of missing the bigger picture? What if the real story here isn't whether this is a winter or a reset, but that the entire climate has changed for good? That this crash isn't just another cycle, but it's a symptom of a massive shift in crypto's role in the global financial system. So let's just ask a totally different question. Forget about winter or rebound for just a second. What if this isn't just another crash? What if the actual rules of the game have been completely rewritten? Okay, and this is where things get really, really interesting. A groundbreaking economic study found that up until about mid-2020, the crypto market was what they call a net receiver of financial shocks. Think of it like a one-way street. If there was chaos in the stock market, it could spill over into crypto. But if there was trouble in crypto, it pretty much stayed in crypto. It was its own little self-contained world. But look at what happens after that breakpoint in mid-2020. The relationship completely flips on its head. Crypto becomes a net transmitter of risk. Now, shocks that start inside the crypto market, like this big crash we're talking about, they spill outwards. They start impacting traditional markets, like stocks. That one-way street, it's now a two-way superhighway, and crypto is sending out a whole lot of traffic. And this data shows us exactly why that flip happened. Take a look at the red line. That's the amount of risk crypto gets from the outside world. It stayed pretty stable, right? But now look at that green line. That's the risk crypto sends out to the rest of the financial system. It has absolutely exploded. The takeaway here is really simple. Crypto isn't some separate universe anymore. It is deeply structurally wired into everything else. But here's the thing. This deep integration, this weaving of crypto into the mainstream, it was all happening at the exact same time that a new, very powerful competitor was entering the ring. While crypto was busy becoming part of the financial establishment, governments all over the world were quietly building their very own alternative. So you've got these two big contenders for the future of digital money. On one side, you have cryptocurrencies. They're decentralized, famously volatile, and they offer a degree of privacy. On the other side, you have central bank digital currencies, or CBDCs. They are the polar opposite. They are completely controlled by the government, they're stable because they're pegged to a national currency, and they offer full government oversight. They basically promise all the efficiency of digital money, but without any of the chaos of crypto. So, after all that, what does this actually mean for you? Well, it means the game has fundamentally changed. The old belief that crypto is a totally separate asset class, or some kind of safe haven from the traditional markets, that strategy just doesn't apply anymore. The playbook is out of date. So here are the new rules of the road. First, you have to understand that crypto is a high-risk asset, and it's now more connected to the wider economy than it has ever been. Second, don't panic sell. Making emotional decisions when the market is down almost always leads to losses. Third, diversify. You've heard it a million times. Never put all your eggs in one basket. And finally, zoom out. Focus on your long-term strategy, not the wild daily price swings. All of which leaves us with one last big, provocative question. Remember, Bitcoin was born out of the 2008 financial crisis. It was created as a direct challenge to the centralized banking system. But now, with huge institutions driving its market and its volatility spilling into the global economy, you have to ask, has crypto's revolution just been co-opted by the very system it was built to replace?